Welcome to episode 5 of the Knoxville Financial Q&A. I'm your host, Brian.
I'm Paul. In the last video, we talked about who we can best serve, and we got a response from Michael, who asked, "Hey guys, my wife and I just watched your last video and really enjoyed it. My question is, what kind of difference in investment return should I expect from working with you or any advisor versus us doing it on our own?"
That's a good question.
What does the magic wall have to say?
What does it have to say? 3%?
All right. Well, that's the answer. That's it for this video. Thanks for watching. We're kidding. Yeah, that really is the answer. I thought it was a really great question because I always felt like we did provide a lot of value over what people that try to do it on their own can do. But I never try to quantify it in a way that there's an actual number, right? Because there's lots of things that go into financial planning.
Yeah, 'cause some of that is tangible, some of that is intangible.
Yeah, for sure. Fortunately for us, Vanguard did a study, and I'm going to link it. It's a PDF. I'm going to link it below. It's pretty in-depth. It's like 28 pages or something like that. So what we've done is basically take that information and narrow it down to a couple of bullet points. Vanguard suggests that there is a 3% difference by working with an advisor. Obviously, they are talking about their own advisors, but when we go through these bullet points, they're essentially listing the same exact things that have been listed on our website for many years. So, Brian, what's the first bullet point?
Behavioral coaching, which goes back to the first thing I said, which was, call me coach. I said it for accountability, but the reality is when you look at how behavioral finance is applied now, it makes all the difference. Most people make bad decisions when it comes to money, both in when to buy, when to sell, on what to buy, borrowing, when to borrow and when to invest. All of those factor in.
Yeah.
What does it say that value is to making the right call and having somebody in your corner?
So according to Vanguard study, that attributes to 1.5 plus or minus 1.5% or more in your returns.
I'd say that's probably fair. I mean, you figure most people, if you apply the idea of like Warren Buffett, when what does he say? The stock market is the only market that when everything goes on sale, everybody runs out of the store. It's a huge deal.
Yeah. Speaking of Warren Buffett, we have a quote on one of the walls in our conference rooms that says, investor returns equal investment returns minus investor behavior. And that quote cannot be understated. Guys, I don't know any other way of saying this except that a lot of you make very bad decisions at the worst possible times.
I mean, it says 1.5%. You figure, if the average market return was 10, that means that you're making a mistake that cost you 1.5% based on so now you're netting what, 8.5?
Yep.
Just because of bad decisions, of selling at the wrong time or buying at the wrong time. And most people, I've always heard it said, time in the market beats timing the market almost 100% of the time. And it just proves that point. And what's that next bullet point?
So the next one is tax-efficient investing, which Vanguard says attributes to almost 0.75% or more in returns. These are things that we've actually have previously talked about in other episodes, but what that means is asset location, tax loss harvesting, and withdrawal sequencing can materially improve after-tax returns.
Yeah, you figure if you're taking money out, if we get a customer that calls and says, "Oh, I need some money," and it's market's up, you're going to take a lot of, taxes. You might as well pair that with either a negative to try to do some tax loss harvesting,
yep.
Or, maybe sometimes it's just talking them off hey, maybe borrow for, a couple 30 days or so and see if we can get a better market return to try to mitigate some of that. Most people underutilize borrowing.
Yep.
Just had a client open up a line of credit secured against their investments to collateralize their investments, so that way they don't have to worry about that. I think something like that's an underutilized tool.
For sure. And as I mentioned, it is something that we've already talked about, but asset location is extremely important. And just to a quick review, all that means is you're taking assets that are tax inefficient, such as dividend paying stocks, and you're putting them inside of an IRA where the taxes are deferred.
Right.
Versus other equities that don't pay dividends that you don't plan on selling. You can put that in an individual account and you won't have a big a tax issue.
Yeah, but to your point too, that the tax efficiencies. I had a client, this is a long time ago, in the state of Tennessee, we had something called the Hall tax, which was anything that was dividend producing. If you made over $5,000 in dividends, you had to pay a 5% state tax. I had a client, wealthy, lots of money, and they were being recommended by their CPA to get out of the dividend producing stocks because they were having to pay a state tax. And, it's like foregoing profit just because you don't want to pay taxes. That's a prime example of like, okay, so you don't want me to make money to avoid paying taxes. Right. I mean, that's just crazy.
Well, we've mentioned this before, but CPAs look at this year, maybe next year, where we got to look 20 years down the road.
Oh, yeah.
So, Brian, what's the next bullet point?
I think it was rebalancing, which was to be right around estimated 0.35% or a little over 0.25%. Which what's funny about that is most of that we put on autopilot by just having quarterly, annually, semi-annually, but we can automatically put that on a portfolio without even having to think about it, touch it, so that the strategy that we start with is the strategy that we end with during that year.
Basically what rebalancing does is it allows you to sell the things that are high and buy the things that are low, which is exactly what you should be doing.
Yeah, because as we know, not every asset class performs the same year over year.
No.
We see so many winners of one year become the dogs of the next.
Yeah, and so also when we're talking about rebalancing, we consider something called portfolio drift, where you might have certain asset classes that you're invested in, and we might put maybe a 2% variance in there. And if it does really well, and let's say it's up at 3%, we might do a rebalance right then and there, whether it's quarterly or not. But that matters. All these things matter when you add them up.
But yeah, that reminds me of that any given Sunday quote, which is like football is a game of a matter of inches. And I feel like investment is the same way. Most people don't really take into account that all of those inches add up.
So the next bullet point is cost-effective implementation, which Vanguard says can increase your returns by 0.45%, plus or minus. Part of the reason they say that is because they're using Vanguard's no-load funds, but we also have no-load fund strategies as well, and we also use Vanguard.
Yeah, costs get expensive. I'd say in the right strategy for the right person, making sure that you mitigate those is important. But I would also say that, there's a reason why Ferraris and Bentleys exist. I've always heard it said that price is only an issue in the absence of value. You don't always want to hop on the cheapest flight, especially if you're going overseas. So, yeah, I would say that may be one of those where there's a trade-off, for sure.
So, Brian, what's the last bullet point?
Withdrawal strategies. I think when you get to retirement, that matters significantly. Balancing Social Security income, balancing what you take from whether it's a Roth, whether it's a 401k, or whether it's a traditional or other qualified money or non-qualified money. If you've managed to sell off property or save up, each pile of money that you can pick from comes with different tax implications. And I could see how withdrawing from the wrong pile at the wrong time, they say, what was it, 1% or less?
According to the Vanguard study, it attributes up to 1%, which is...
That's significant.
Significant.
That matters. Sure. I mean, and I would say that that's actually probably fair. I mean, I've seen instances where people have withdrawn money from the wrong place at the wrong time. Whether it illustrated a 1%, I could see that. That's reasonable.
Yep.
But yeah, I could see how, withdrawing from the wrong pile at the wrong time matters. You just look at Social Security by itself. If you wait 62 to 65, that's a big jump. Okay, well, if that accounts for 1% income difference, that matters.
I mean, I don't know how you quantify this with a percentage, but what if we can help you create a strategy where you don't outlive your money, right? Is there a value that you can quantify that with? Because I don't know. It just seems like that is something that is priceless.
It is. I mean, don't outlive your money is the probably the number one. Well, not accumulating enough, but then
Right.
not accumulating enough being the number one problem, and then I'd say that the second part of that is outliving your money.
So guys, basically this all adds up to 3% according to Vanguard, right? And so we obviously broke down a 28-page document in 10 minutes. So I wouldn't say that this is guaranteed in any way,
Sure.
shape, or form, right? It's just their study that they did. The numbers seem realistic to me. In fact, the one about the behavioral coaching where they said 1.5% or more, I'm leaning towards the more side, in all honesty. The amount of people that we've had come in who have made really poor decisions at really bad times that we could have prevented from happening would have saved them a lot more than 1.5%.
For sure.
Right? And so I think that's the biggie right there. Out of all the other ones, the behavioral coaching, which is something that we really focus on, based on the amount of education that we put into working with our clients, to me, it's obviously the highest one on there, but it also stands out to us as being
The most important.
with or without a Vanguard study. All right, so with all that said, we're not saying that we're going to outperform everyone by 3%. We know that there's some DIY investors out there who spend a lot of time, have good discipline, and do really well on their own, and that's fine. We're just talking about the average investor that comes in and works with us, and we're trying to justify paying. They're trying to justify paying us a fee. And this 3% number, by the way, is net of fees. If you read the whole study,
But most of those are statistical anomalies. When you start looking at statistics and sample size, you increase the sample size, you increase the accuracy. And so I would say when you start looking at those people that can do that, they are the outliers. Those are the people that don't fall in the general public. Most of us, kids, baseball games, softball games, life gets busy. It's the same reason that I always talk to clients or potential clients and say, do you pay somebody to cut your hair? You can cut your hair. Don't get me wrong, it may not be good, but you can cut your own hair. But why do you pay somebody 50, 100, 150? And it's just sometimes simply to outsource some of my life, buy back my life. Why do you pay somebody to mow your grass? Lots of people pay somebody to mow their grass. Not because, you need somebody to mow your grass, but sometimes it's just better to buy your life back. So, focus on your life, focus on spending time with loved ones, focus on the things that matter. Let somebody else handle something that, we can prove that there's an advantage to.
Yep, 100%. So, Michael, our phone number is 865-342-7766. Be sure to ask for Paul. No, I'm kidding. Brian and I work with most of our clients together anyway. So anyway, we have a couple of upcoming videos planned that I think the one about the tips and tricks is going to be a really good one. So stay tuned for that. And I think we covered all the bases on the Vanguard document here. All right, so the document will be linked below. It's a PDF file. You're welcome to download. It's going to be on our website. As I mentioned before, though, if you do download it and look through it, if you're going to spend time to read 28 pages, I invite you to spend just 2 or 3 minutes on our website, and all of that same information is on there, as I mentioned earlier, and it's been on there for years. So we feel pretty confident in being able to use this document and that 3% number as a correlation to what we do for our clients. So with that said,
Signing off.
signing off.